I'm not exaggerating when I say this. I get over 500 messages a day from traders asking, why didn't this trade work out? And you know what? It's the same mistakes over and over again. New traders jumping in head first, making impulsive decisions, and then wondering why their accounts are drained. It's like trying to build a house without a foundation. You might get a few walls up, but eventually it's all going to come crashing down. That's why I'm making this video. To help you build that solid foundation, we're going to break down the top 10 trading mistakes that could be costing you money. And more importantly, I'm going to give you actionable solutions to fix them. Think of this as your trading crash course, your guide to navigating the markets with confidence and avoiding the pitfalls that trip up so many new traders. So whether you're just starting out or you've been trading for a while and you're stuck in a rut, this video is for you. Let's jump right in. The first mistake I see is entering a trade too late. You're watching your charts. You see a currency pair like AUD, USD take off, and you think, this is it. The price breaks past the 200-day moving average. There's momentum, and you hesitate. By the time you click the buy button, the move is over. The market consolidates or reverses, and you're left holding the bag. Focus on catching the first move. That initial surge past the 200-day moving average, that's your best chance. Don't chase the move once it's gone parabolic. Patience is key in trading. It's like waiting to harvest a crop. You don't pick the fruit before it's ripe. You wait to maximize your yield. Trading is the same way. Be patient, wait for your setup, and capitalize on it. Now, let's talk about the Relative Strength Index, or RSI. It's a popular indicator, and for good reason, but it's often misunderstood. The second mistake I see traders making is trading RSI divergences without waiting for confirmation. Here's what I mean. You're in a downtrend, and you see the RSI making higher lows while the price is still making lower lows. Classic bullish divergence, right? You think it's time to buy, but the trend doesn't care what you think. The price keeps dropping, and you're left wondering what went wrong. The problem is, you're not respecting the trend. A divergence is a potential reversal signal, but it's not a guarantee. Never, and I repeat, never trade a divergence without waiting for a break and retest of the trend line. That break and retest is your confirmation that the momentum is shifting. It's like waiting for the traffic light to turn green before you drive. Don't jump the gun just because you see a few cars slowing down. Alright guys, let's talk about something that's absolutely crucial to your trading success, and that's using a stop loss. Seriously, this is non-negotiable. Imagine this. You're driving down the road and suddenly a car swerves into your lane. What's the first thing you do? You slam on the brakes, right? That's exactly what a stop loss does for your trades. It's your emergency brake in the market. It automatically gets you out of a trade when it hits a certain price level, preventing those catastrophic losses. Think of it like this. Would you rather lose 1% on a trade or watch your entire account get wiped out? Setting a stop loss is all about managing risk. It's about protecting your hard-earned capital so you can live to trade another day. And trust me, you'll be glad you had it there when the market throws those inevitable curveballs your way. Now, I get it. You're eager to start making those big bucks in the market. But here's the thing. Risking too much money too soon is a recipe for disaster. It's like going from driving a bicycle straight to a Ferrari on a racetrack. Many new traders fall into the trap of thinking that a bigger account equals bigger profits, faster. But remember, trading real money comes with real emotions. Fear and greed can cloud your judgment and lead to impulsive decisions that can cost you dearly. Instead of going all in, start small. I'm talking about a $20, $50, or even $100 account. This isn't about limiting your potential. It's about learning the ropes without putting your entire financial well-being on the line. Think of it as paying tuition for your trading education. The lessons you learn with a small account will be invaluable as you gain experience and confidence to gradually scale up your position sizes. Let's talk about indicators, those fancy tools that promise to unlock the secrets of the market. Now, indicators can be helpful, but here's the thing. Too many of them can do more harm than good. If your chart looks like a rainbow threw up on it, you're definitely overdoing it. You've got moving averages, crisscrossing, oscillators flashing, buy and sell signals, and all sorts of other indicators creating a symphony of confusion. Remember, simplicity is key. You don't need a million indicators to tell you what's happening in the market. Stick to one or two that you understand and that align with your trading strategy. A clean chart leads to clear thinking and ultimately better trading decisions. Focus on mastering a few key indicators instead of trying to juggle a dozen at once. Trust me, your trading performance will thank you. Mistake number 6 is a classic newbie trap, changing your strategy too soon. Constantly switching strategies is like building a house on shifting sand. Imagine baking cookies and swapping ingredients before tasting the first batch. Give your strategies time to bake and perform. Stick with them to understand their strengths and weaknesses. Even the best strategies have losing trades. Don't abandon a good strategy after a few bad trades. Now, let's talk about mistake number 7. And this one's a biggie. Expecting to get rich quick. We've all seen those flashy ads promising instant riches. But let me tell you, those are pure fantasy. Trading is not a get-rich-quick scheme. It's a skill that takes time, dedication, and a whole lot of patience to master. Think of it like learning to play the piano. You wouldn't expect to sit down and play Chopin flawlessly on your first try, right? It takes consistent practice, learning from mistakes, and gradually building your skills over time. Trading is no different. You're going to have losses. You're going to make mistakes. But it's how you learn from those experiences that will determine your success. Don't get discouraged by the learning curve. Instead of chasing overnight riches, focus on building a solid foundation of knowledge, developing a disciplined approach, and treating trading like a business. Remember, slow and steady wins the race. Mistake number 8 is a common one, especially for those new to the game skipping demo accounts. Look, I understand the allure of diving straight into the real thing. But trust me, practicing with demo accounts is crucial, especially when it comes to your hard-earned money. Think of a demo account as your trading training ground. It allows you to test different strategies, get comfortable with the trading platform, and most importantly, make mistakes without risking a single dollar of your own capital. Imagine trying to learn to drive on a busy freeway without any prior practice. Sounds terrifying, right? Trading with real money without first practicing on a demo account is equally risky. Use this time to experiment, track your trades meticulously, and analyze your wins and losses. The more you practice in a risk-free environment, the more prepared and confident you'll be when you're ready to trade with real money. All right, moving on to mistake number 9, and this is a big one, especially when you're starting out. It's called strategy jumping, and it's basically the trading equivalent of being a kid in a candy store, except instead of candy, it's trading strategies, and instead of getting a sugar rush, you're getting a portfolio crash. New traders hop from one strategy to the next, chasing that elusive holy grail of trading, that one magic formula that's gonna make them rich overnight. But here's the thing, every strategy, no matter how good, is gonna have losing trades. The key is to find a strategy that has an edge, that wins more than it loses over the long term, and then stick with it. Consistency is key in this game. So, find a strategy that aligns with your risk tolerance, your trading style, and then give it a real shot. And finally, we come to the 10th and final mistake that traders make: quitting too soon. Look, trading is hard. It's not a get-rich-quick scheme, and it's definitely not for the faint of heart. There are gonna be ups and downs, winning streaks and losing streaks. But here's the thing. Everyone who's, ever made it in this business, everyone who's consistently profitable, they've all been through the same struggles. They persevered, they learned from their mistakes, and they came out stronger on the other side. So, if you're serious about becoming a successful trader, you can't be afraid to fail. Embrace the failures, because that's where the real learning happens. Remember, the only way to truly fail is to give up. So, there you have it. Guys, the top 10 trading mistakes to avoid. If you can steer clear of these pitfalls, you'll be well on your way to becoming a more profitable and consistent trader. And hey, if you found this video helpful, do me a favor and hit that like button and subscribe to the channel for more trading tips and strategies. Host, if you're serious about improving as a trader, check out my channel. I have over 100 videos covering strategies, tips, and more. Start with this video here. Don't forget to subscribe, and I'll see you in the next one.